Gaps are one of those things that are very widely taught, and the traditional understanding of gaps actually is pretty good. I know, you're surprised to hear that. You're like, what, Barry? There's some actual technical analysis that is traditionally taught, which you actually like, you approve of the traditional teaching of something in technical analysis. Yeah, it's rare that that happens, but this is one of those cases where I do. So what I'm going to share with you now is not anything that I've created or I've come up with. It's actually widely known. But for those of you who are not familiar with it, I'm going to share it, and maybe a few extra little tidbits will come up here that are unique and reflect on how gaps connect with my personal trading methodology. So let's go right into it. We don't need to spend a lot of time on this. I talk a little bit about this in my swing trading course as well. I'll spend more time on it there. But gaps are important because you do see these, and they are an important part of trading. So basically, there's three types of gaps. We refer to them as breakaway gaps, continuation gaps, and exhaustion gaps. Some people have a little different names for them. That's what I call them because, again, I just think that's very logical. Those three names really summarize what they are, what they mean, and where they occur. And that's the whole key with gaps, is where do they occur in the context of the whole chart. So a breakaway gap, what we're looking for is generally the market's been maybe going along in, kind of consolidating, kind of a narrow range, low activity, low volatility. And then all of a sudden, boom, this bar comes up way up here. So this action here, pretty, mundane, pretty narrow range, like I say, low volatility, and then all of a sudden, whammo, something happens, and all of a sudden people are enthusiastic about the market. Whereas before, they were not. They were lackadaisical about the market. So this is a breakaway gap. It occurs, well, we expect it to occur at the beginning of a new impulse move, and hopefully at the beginning of a new trend. So it's a very enthusiastic move, and something that's a little unique here is we do consider this a parabolic pattern, a parabolic move. Again, it's invisible. It's an invisible parabolic bar there, essentially. But it is part of my parabolic energy that I refer to, even though there's no bar there. And because it reflects that kind of strong, vertical, wide range move in a short period of time, which is characteristic of the parabolic energy. So that keep that in mind, that that's the type of energy that we're looking for here. So now, breakaway gaps, one of the most common things that you'll hear is that gaps close. Of course, the Japanese say, they call them windows, and they talk about closing the window. A breakaway gap we consider less likely to close, at least in the near future. I'm not really that big on gap closes. I just trade the energies. If it closes, great. If the energy turns around so that it looks like it might close, that's cool. That's what I'll trade. But just based purely on the fact that we have a gap, I'm not expecting it to close. I'm just going to trade with the energy, and the energy right now in a gap like this is up. It's new enthusiasm to the upside, and therefore there's no expectation in my mind at this point on a breakaway gap that it's going to close in the near future. I'm thinking bullish. Now, as I watch the energies, that may change. We trade bar by bar. We let the market tell us what's going to really happen. But some people will just, every gap they see, they're trading a gap close. And I think that's ridiculous. So, try it sometime. Trade every gap close that you see, or trade every gap and try to close it, and see how well you do. Probably not too well. Okay, so anyway, then the market goes up and whatever, it does its thing. And then all of a sudden, we get another gap. Okay, big window there, big gap. So this is a continuation gap, and that just means that it occurs somewhere after the breakaway gap. Now you can have multiple continuation gaps as this market continues to move up. It's just part of the continuing move of this new trend. And how many continuation gaps will you have? You don't know. Continuation gaps are tricky because you could have 1, you can have 2, you can have 3, you can have 5. I mean, the longer it goes on, the less likely it is to continue, just like with everything else. And so therefore, with a continuation gap, I may or may not trade the first one. I'm not really too interested personally on trading continuation gaps. I do like to trade breakaway gaps. I'll trade those. But I'm not a big advocate of trading continuation gaps because, again, we've already moved so far in the direction of the market, and you never know what's going to happen after that. It's just kind of like when you're looking for an edge in the market, you want to trade the edges of probabilities, and that's why all my trading is based around that. So, for example, when we're looking to get into a trend, we're looking to get in early in the trend. When we're looking for reversals, we're looking for those in extended trends, right? Those are like the extreme ranges of market movement. Those are the times we're looking to get in. We're not looking to get in the middle of market movement during the average trend, but either early at the beginning or late at the end. And we trade the edges of the market to get a probability edge. So the same principle applies to gaps. I'm either going to be interested in getting that first gap, the breakaway gap, or the last gap. And the last gap is called an exhaustion gap. Now, here's the other tricky thing about gaps. Since you don't know how many gaps you will get in a trend, you'll never be perfectly sure which will be the last continuation gap, because that last gap is the exhaustion gap. So the only gap that you can be sure of which category it fits into is the first one, the breakaway gap, because it's the first gap and it's very clear. After that, I mean, your first continuation gap, I mean, that could be the end of that trend, and what you think is a continuation gap, oh, actually that ended up being your exhaustion gap because the market actually stopped going up there. So every gap after that has the potential of being the last gap, which is your exhaustion gap. So we look for certain characteristics in that exhaustion gap, and I'll point those out to you. Well, I'll just tell you what they are now, and then we'll point them out on real chart. Basically, we're looking for extremes again. So we're looking for extreme ranges, we're looking for extreme candlestick patterns, we're looking for extreme volume, and we're also looking for extreme wave counts. So all those things we're looking for with an exhaustion gap. Okay, so let's go ahead and pull up some real charts and take a look at some gaps. All right, so here we go. So this is actually a great example of a breakaway gap, because what we have is we have kind of a consolidation pattern here, right? What do we have? What is this pattern? Let's do a little quiz. What is this price pattern down here? See if you can see it. Name that pattern. Go ahead. I actually encourage you to pause the video if you need a little extra time, because I'm about to tell you what it is, but it's better if you try to figure it out on your own. Well, again, easy way to figure out a pattern is to what? Connect the dots. So we connect the dots, meaning connect the cycle highs, connect the cycle lows, and what do we got? We have a triangle pattern, right? Actually, it's a descending triangle. And so we look for a breakout, and then this time it breaks out in a gap pattern. It gaps up. It gaps. Here's the thing about gaps, especially on daily charts. One of the things that gaps are famous for is breaking We're just bypassing support resistance levels. So the market doesn't want to deal with this trend line. It doesn't want to deal with this high. It doesn't want to deal with that high. It doesn't even want to deal with the 50 MA. And it says, screw all that. We're going to just open the market up here. And what that does is removes all that literal resistance to allow the market to move up. Because otherwise, people are going to find these resistance levels and they're going to take profits. They're going to short off of it. It's going to make it harder for the market to move up. So by opening the market up here, it's got pretty much free rein to continue going up. So that is, sometimes people call this like a gap and go. It doesn't come back and close right away. That is a breakaway gap. Where would you enter on this? That's always the magic question. Again, you're not going to be able to use your indicators for this kind of a pattern. So therefore you just treat it like a what? A parabolic move, as we said. So here we have our two narrow range bars right next to each other. They're going basically sideways, a little bit of a move up, maybe even. And on that narrow range bar, you could just enter above the high of that to see if you get the continued movement up after the either flag pattern, pennant pattern. You're just waiting for a little consolidation and enter above that. That's about the best you can do on these. And then keep your stop really tight. And this one works out very nicely. And that's all she wrote on this. But that's a very nice breakaway gap. If you just remember, consider that there's like a big parabolic bar here. That maybe even went up a little bit higher like that. And then you get your little inside bars, your little contraction bars. And that's what we're trading. We're trading a parabolic move like that. Okay. Now remember, a breakaway gap always occurs out of consolidation. So for example, it doesn't mean it's the first gap. That's a technical distinction. This is my distinction. So for example, some people would look at this, they say, oh, here's a move up and then there's a gap. So that's a breakaway gap, right? No. A breakaway gap is defined, in my methodology at least, by having contraction beforehand, consolidation beforehand, some sort of, just small volatility movement, and then it's characterized by new volatility coming into the market. So this is not considered really any kind of significant gap at all for me. Now here, market's starting to turn down, get a nice trend. We're consolidating here, narrow range, consolidation, kind of sideways movement, and then boom, a gap. So that's a breakaway gap. Comes down, boom, another gap here, just where that A is. A is in the gap. But that's a continuation gap now. We come down, make our wave 3, and that's all she wrote. There's really no exhaustion gap here. We just have a breakaway and a continuation gap. Okay, now a word of warning. Remember I said before that where these gaps occur in the context of the chart is so important, just like everything else. This is why I talk about structure early on in Foundations Course 1. You've got to understand the structure of charts, because all these other things are relative to the structure of the chart and are dependent upon the structure of the chart. So for example, here we have a gap, and it has some of the characteristics of a breakaway gap, right? Because we have a nice consolidation here, and then boom, new volatility coming into the market. The problem is, if you look at the context of the chart, it's late in the trend. And so it's coming in on the last impulse move into a wave 5 high. Therefore, we're not really interested in trading it anymore. It's more like an exhaustion gap because it's coming in late in the trend. Now, remember, yeah, we got three gaps: breakaway, continuation, and exhaustion. But you don't have to have all three in a move. You don't have to have a breakaway and a continuation in order to have an exhaustion. Those are merely terms that are referring to where in the chart they occur. And because this is occurring late in the trend, we would consider this an exhaustion gap. So markets quite often, not always obviously, but often, will end with a bang. A lot of enthusiasm coming in. Usually it's a lot of people who are wrong, coming late to the party. Isn't that typical? And they're the ones basically getting screwed over, quite honestly. So these are not things you want to participate in unless you want to trade against them. And they're especially powerful, again, obviously on a wave 7 or wave 9, just as before with any other type of reversal pattern. This can be another thing you look for in your reversal patterns, are exhaustion gaps. Now, I mentioned this earlier, but this really applies to this video, so I need to mention it again because it's so important. You've got to be careful with gaps. Gaps don't mean something on every chart. Some markets just have a lot of slippage to them. So for example, look at this chart here. There's a lot of little gaps, right? A lot of gaps. Little gap here, little gap there, gap there, gap there. This is just one of those markets, happens to be Apple, where there's a lot of little gaps. And so these little gaps don't necessarily mean anything with regard to technical analysis. So if you're going to trade gaps, look at the chart and ask yourself, okay, is this a chart that just has a lot of slippage between the days? And if it does, then probably the technical understanding of gaps is not going to apply so much to this chart, and I can't really use it here. So be very, very aware of that. That's an important thing to understand, to be defensive, that gaps in some charts are very, very reliable, and on others where you just got a lot of slippage in between each bar, you can't rely on them. They are not technically significant. Alright, now Qualcomm here in daily chart. I just want to show you this because this is a pretty wild chart, and yeah, it's just, again, kind of gets you used to things that you can look forward to when you trade gaps. So okay, we've got our little narrow range pattern here, consolidation, boom, big gap right through the 50 MA. Comes down, okay, now we start our new trend pattern. As we do, we get stuck above the 15 EMA. We get a little pinball pattern there. Then we get, again, consolidation and a gap up. But then this one goes nowhere, right? It just kind of goes sideways and consolidates. So they don't all result in dramatic push in the direction of the gap. And then another one, boom, gaps. Now again, notice it gapped below the 15 EMA and the 50, so it wouldn't have to mess with any of that. Now this time it does take on a new direction and goes down quite nicely. Down, 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 down. Then it comes back up. Consolidation. Boom. Another nice gap here. And okay, now here's one thing we wanted to look at. Horizontal line. Let's look at our gap close. And this is something you need to be aware of, because this goes against and really can be frustrating for those trading traditional approaches. So here's where the market, the high of the market of the last day, then we get our gap. Now a lot of people will be looking for this gap to close, and the market does not really go up, does it? It goes sideways. But look at that, the gap actually never closes. It retraces here, or retraces here, or retraces here, and never touches the bar, and it stays a little distance away even. I mean, if it got real close, I'd say, well, that's close enough. But on each one of these, there's enough distance there that most people are not going to get an entry on a gap close here, because technically the gap does not close. And I'll tell you, I've seen this a lot. So is this some sort of thing where people are saying, well, everyone expects the gap to close, so we're not going to let it close? I don't know. All I can tell you is I've seen this a lot. And so trade the energies, trade the technicals, and be very careful of the stuff that people tell you. When you hear everybody telling you that something's true and this is the way it works, it probably doesn't work. Okay. Now, here we get a nice, here's our 5 waves, so this would be, okay, maybe an exhaustion gap, right? But look, market keeps going, wave 7. Oh, okay, here's another gap. Wow, now we're really extended in the trend. So maybe that's an exhaustion gap. Puts in a 9 in a failed 11. So this is what I'm saying, where you never know which is going to be a continuation gap and which will be your final exhaustion gap, even late in the trend. These continuation gaps can be very, very tricky. That's why I don't find them helpful. We can label them, we can call them something. It's good to have a name to call them so that when we're analyzing the market we all know what we're talking about. But as far as trading them, I'm not really big on it. So it's just a good chart to show you things that are not so neat and tidy. I really like to show that so that you have a more realistic approach to the things that we're discussing.